Paul Nolte is the Senior Vice President and Portfolio Manager at Kingsview Asset Management. He's standing by to discuss the number here and some of the recent price activity. Paul, thanks for giving us part of your Friday morning. Let's begin with this GDP number, well above expectations, along the lines of what we saw yesterday from the durable goods orders. Is this going to force the Fed to rethink their position in terms of next week's potential rate cut?
I think it's already baked in for next week. They're going to cut a quarter, but I think what may happen is you may see them step aside. So in essence, what they're doing is taking December off the table and now going to sit and watch and be patient, be data dependent, and take a look at what happens to the economy over the course of the rest of the year. That was one of the concerns that we had coming into, the expectations for this rate cut. The economy is not doing all that bad. It is okay, and the 2% GDP number is pretty much in line with what we've been experiencing for the last 10 years. So again, the reason for the rate cut, I think, is strictly trade related, more of a concern of global slowdown, and a U.S. rate cut's not going to solve that problem until the president of both the U.S. and China get together and come to an agreement.
So, Paul, if the rate cut's not going to solve that problem, I mean, in theory, one thing it seems like it could do is kind of spark some inflation. So you've got the Fed that's trying to cut, as you mentioned, relative to some of the concerns globally. But ultimately, we know that lower rates, well, we think lower rates fuels inflation. It certainly hasn't for the most part of the last 10 years. But can you talk to us about how that could be a direct result if it's not necessarily a kind of a U.S. economy-driven cut?
Yeah, and that's one of the things that we continue to wrestle with is, do lower interest rates create the inflation? And you're right, the last 10 years, inflation hasn't been an issue, even with zero interest rates and negative interest rates around the world. And I think really what we're looking at is a problem with debt. And I think debt is the wet blanket, if you will, that is containing inflation at this point, as consumers in general, although they are spending, have kind of pulled back. They're saving a little bit more, certainly globally, maybe not in the U.S. So savings rates are higher in Europe and in the Asian countries than they are here. And so the spending isn't there. We're seeing in the trade numbers are pretty quiet and actually have come down. So again, we're not seeing those sparks that are going to create inflation. Wages are another key to that, and wages are growing 2.5–3%. That's not too bad. That's in the middle part of the historical range for wages. Until we see those really start to pick up, it's going to really be hard to get sustainable inflation going.
Yeah, well, we'll get some insight in terms of that next week, Monday, with the personal income and spending, and then also Friday in terms of the jobs data and the wage component there. But let's talk a little bit about crude, Paul, about some of the demand concerns, really speculation in terms of demand concerns. We're not seeing any as of yet as far as some of the numbers that we're seeing, GDP, durable goods orders. It looks like spending's pretty good, and demand for consumers has been as well. But we continue to see draws in the inventories. Last week, we saw one, well, for the most part, I think it's 5 or 6 draws in a row. We had this week a large one in the APR, a large draw also in the EIA. I mean, I'm starting to wonder, with all these draws, with the economic data that we're seeing, is there a real demand concern present, or again, is just speculation?
I think right now it's speculation. Some of the numbers, too, are berry related. So the hurricane coming through the Gulf. So production came down a fair amount, and so we're not producing as much. And we saw that with past hurricanes as well, where you get a big drop in production that gets recovered in the subsequent weeks. If we look at where inventory levels are today versus maybe a 5-year range, we're still in the upper half of inventory levels. So even though we've taken a draw, we've been building an awful lot of inventory over the last couple months. So again, and when you look at it from a technical perspective, energy is kind of getting into a coil pattern as we come off the highs and up from the lows. And we've got a confluence of the 50 and 200-day moving average pretty much right where we're at here. So if we can get a move much above 60, much below 50, I think you can really see energy take off on either direction. But for now, we're calling for a range of 50 to 60 to be the normal for quite some time.
Yeah, it's interesting that you mentioned that because we had Ashley Peterson on from Stratus Advisors yesterday, and she was saying the same thing, basically, Paul. She was saying, hey, while we have been seeing large draws, we're still building up inventories. And again, you've got to ultimately talk a little bit about the supply in terms of that component, and that's more so the reason as far as some of the record production that we've been seeing here. But let's talk about, again, the fact that one of the reasons why we've been seeing crude somewhat muted in terms of upside price activity this week is it seems like we're hearing of a situation at least diffusing somewhat in terms of the developments as far as Iran and the UK and that tanker and last week's developments. I think it was this week I heard that the UK sent a negotiator to Iran to actually try and diffuse the situation.
Yeah, you know, and that's one of the things I think really it is a strategic point. The Straits of Hormuz is where a lot of oil goes through, and that really, we do not globally want that to be a flashpoint or where they shut it down completely. So although there's been some skirmishes, there's been some drone issues, etc., ultimately I think you do want to have negotiations, making sure everybody's on the same page and at least playing nice with each other as best you can in that environment. So it's not a surprise. I think we've sent some ships that way, so we do have a presence there as well to try to keep those corridors open.
Yeah. Paul, one more question, then we'll let you get on with your day. I'm seeing reports this week from Reuters of an unexpected September OPEC Plus meeting. They said a panel of OPEC and non-OPEC ministers will meet on September 12th in Abu Dhabi. They said that the Joint Ministerial Monitoring Committee, which includes Saudi Arabia and non-OPEC Russia, observes oil markets developments and can make a recommendation to the countries signed up to the deal, a group known as, again, this is OPEC Plus. Are we about to get more cuts here, do you think, or recommendations for more cuts?
Maybe. You know, I think OPEC is relatively happy where energy prices are in that 50 to 60 range. You know, again, what they really don't want is anything below 50, because that will hurt a lot of those countries. 50 plus isn't bad, and they really don't want to get it too terribly high because then you will see demand drop off too. So again, they're trying to strike that balance, and I think that balance, at least for now, is in that 50 to 60 range. Yeah,
I was going to say, it seems like they found it. Paul, really appreciate you joining us here this morning and giving us part of your day. Traders, that's Paul Nolte. He's the Senior Vice President and Portfolio Manager at Kingsview Asset Management.